and welcome to another video by The Bottom Line. In today's video, I'm going to cover the monetary policy in depth, what was announced on the 6th of October, the rationale around it, what is the structure around the thinking and the thought process of the Monetary Policy Committee, how do they see inflation broadly, and the Monetary Policy Report has given significant amount of details about global and domestic health of the country. So I'm going to touch upon all those pointers and with some charts to explain what the true values are. The Reserve Bank comes up with its own numbers, its own research, and I find it to be very reliable in terms of understanding what the right numbers are of the economy and where the economy is being driven as of now. So let's begin with it in this entire detailed video of the monetary policy decision held on the 6th of October. So if we look at the key pointers that we'll cover, first of all, what is the consumer confidence looking like? What is the inflation trajectory of the CPI, the headline inflation, the housing market, and the inventory of the housing market, which is a very important indicator of how well the economy is doing in terms of demand. The impact of the exchange rate against the dollar, what we will have on inflation, which is a majority point. Generally, we have the perception that the appreciation or depreciation of the dollar does not affect inflation, but it does to a certain extent because of demand and supply of the rupee in the economy and in the world. We'll see what RBI sees that as the extent of the appreciation or depreciation. The monetary transmission concerns, which is a very wide factor, a very wide topic to cover in a small video, but we'll try to touch upon where the monetary policy transmission concerns are there. RBI hinted towards the personal loan growth being the concern. And then we'll end this with some global comparisons around where we are in terms of our monetary policy committee and the world's monetary policy committees and how the decisions are being taken. So if we look at the first key pointer in the consumer confidence, the consumer confidence still remains significantly lower than 100. Now 100 is generally the benchmark, so the consumer confidence is low. If you see the future expectations here, definitely the Reserve Bank thinks that with the future expectations, the consumer confidence should rise with standard monetary policy acts being taken, big decisions being taken that are right for the people. But as of now, the consumer confidence remains significantly low. This is in line with what is happening in the economy, where inflation is high, it is persisting high, the interest rates are significantly high, there are many job cuts going on, companies are facing significant amount of turmoil in terms of profitability. So all of this lines up with the consumer confidence in the citizens of the country. If you look at the inflation trajectory, and these are 4 quarters ahead expectations that the Reserve Bank has provided. And the most important part of this is a survey by Reserve Bank themselves, and they do not really rely on any other information. Definitely the CPI numbers come from NSO, but the projections are done internally within RBI. That's why I have a lot more credibility added to this chart when it comes right from the RBI. So if we look at the inflation short-term expectations, if you see 2023 Q1 to Q4, they do not see any movement towards 4%. The 4% mark, which is the Reserve Bank's benchmark, will only come in their expectations in 2024 and 2025 Q1 and Q2, right? So this is slightly concerning, but it is also the truth, or it is a matter of the fact at this point that the inflation is significantly on the higher side. And if we do not have uniform rainfall across the country, if we have supply shocks of certain grains, pulses, cereals, dairy, or meat, that could affect the inflation in a very significant way. So a good watch on inflation would help us understand what is truly going on in the economy. If we look at the inflation expectations, the Reserve Bank has clearly mentioned that the 3 months and the 1 year ahead median inflation expectations of the household have dropped, which is a good thing, because first, if the expectations of inflation drop, the inflation automatically starts dropping. So the attempt is to survey what the citizens of the country think in terms of the 3 month and 1 year ahead median inflations. They do seem to now think, which was not the case in the previous monetary policy, but they now do seem to think that the inflation is likely to reduce as compared to the previous monetary policy numbers, where they were not expecting the inflation to reduce. So that is a good improvement sign which RBI sees at this point of time. If you look at the housing activity, and this is a chart that comprehensively tells us three things. One, what are the number of units that have been launched? What are the units sold? And how is the unsold inventory looking like? So if we look at the comparison, the activity of units launching has also significantly reduced in the Q1 of 2023 and 2024, which also tells us that the real estate developers are also taking a breather because of the high interest rates persisting. The number of units sold have remained sticky around the same number of units in 1,000, about 500,000 units being sold. But if you see, there is a sharp uptick in the unsold inventory of the housing. Now this provides a very important number that drives the discussion around the demand in the economy. Housing is a very important factor to suggest the demand in the economy. So when the housing market is booming, we generally have the perception that the housing economy or the demand in the economy is significantly higher. So the unsold inventory is giving us a strong signal that the consumption, the demand is slightly muted at this point. If you look at the impact of exchange rates, now the rupee has definitely been one of the good performers in comparison to the other currencies that have depreciated against the dollar. Shortly, I'll show a chart of why I'm saying that. But if at all the rupee depreciates by 5% over the current baseline, then the RBI is expecting that the inflation could edge up by 35 basis points, while GDP could be growing higher by 25 basis points by stimulating exports. So if we depreciate in terms of currency, then also there will be some minor impact of 35 basis point on the inflation rising. So this is also something that we have to factor. It is not just the internal basket prices of certain commodities, but we are also affected externally by the dollar. And if the other way happens, where the INR appreciates by 5% relative to the baseline today, then the inflation could moderate by 35 basis points as well. So a lot depends on how the dollar also performs. If I have to take a very informed guess on what the dollar is likely to do, then I do see the dollar to weaken in the coming days, because they are also fighting with high inflation. So it's not that the consumption is going to be very high in the US economy as well. So we do see that the dollar is likely to depreciate against the other currencies, and the other currencies should appreciate against the dollar, which should also help us in easing the inflation much before we think, although it has a very minuscule impact as compared to the actual prices in the economy of commodities. But it is one of the factors that will affect how our inflation trajectory will go in the near future. If we try and understand monetary transmission, now this is a very important point, and the Reserve Bank has kept on being very rigid about this right from when the Reserve Bank has introduced this concept. What this means essentially is, see, any decision that the Reserve Bank takes of an interest rate hike, of an interest rate reduction, is generally being done for the fact so that the banks transfer this effect to the consumers, and the consumers then feel that either the interest rates have hiked too much, so now I should not go for any more loans, and thus the demand starts curtailing. But if the Reserve Bank is taking a certain action, and the banks who are finally reaching out to the consumers are not having the same effect on their deposit and lending rates, then the impact of what the Reserve Bank is trying to do reduces, right? And that's where we are seeing that the inflation, ideally with a Reserve Bank increasing the repo rate by 250 basis points till date, the transmission from the banks to the consumers has not been that great, right? I definitely do not expect the 250 to transmit 250 to that, because the banks have their own spreads on it. But there is a definite level that 90% of it should be transmitted to the consumers, right? So that the remaining can remain as the profit margins or margins for the banks to play on, but the rest of it should get transmitted if we want to have a quicker control on inflation. If you look at the charts here, the transmission from the Reserve Bank has been 250 basis point, but the transmission from each of these sectors or each of these kinds of banks has not been more than 150 or 175. If you look at the chart to the right of it, which is Reserve Bank giving out 250 basis point rate hike, all the deposits, the 1-year deposits, the 2-year deposits ideally should have given an increase in interest by close to 2% or 2.25% if we were to say that the transmission has been done correctly. But The banks seem to be on a different note altogether here, that the transmission is not being done correctly, because of which the deposit collection to the banks is also going to slow down. This is the right time for the banks to also collect deposits back from the consumers, which decreases the level of demand in the economy. Right? When the money comes back to the banks, that means the disposable income with the individual reduces by that amount. So we have to understand that transmission is a very important aspect. If the Reserve Bank is giving you certain leeway to increase the interest rates, the bank should latch on to it quickly, and that's where transmission becomes key to inflation reduction or inflation control in the economy. And if you look at the most favorite investments of Indians, that's what I've observed when I've spoken to people, is NPS, the Public Provident Fund, the Sukanya Samruddhi scheme, which are supposed to give you the same kind of transmission, but they are merely giving 1/4 or 1/5 of the actual transmission done by the Reserve Bank of India. Even temporarily, those rates should ideally increase, but they have not increased. So those kinds of investments also are not showing the right level of transmission that the Reserve Bank is trying to indicate in the economy to try to curb the demand out there in the system. But hopefully with time, before it's too late, they do provide the kind of transmission that is required. Let's hope for that at best. And this is exactly why the inflation takes time in an economy, because the Reserve Bank cannot directly act on you and me. There are intermediary banks which have to transmit this effect for you and me to realize the heat of the interest rates and try to reduce our burdens. If we do not have debt, then we realize that great, some banks are giving me great deposit rates, let me go and make an FD or put some savings into that bank, which gives away the income from me to the bank for now, and now I have less to spend. If I have less to spend, that means the consumption in the economy is significantly going to go down. That's the expectation. If we look at some of the broad global comparisons that the Reserve Bank has given, we have been one of the top global equity market performers as compared to many other advanced economies, which is seen on the broad indices that we have. It's seen on Bank Nifty, Nifty 500. Everywhere we have significant amount of performance as compared to the S&P or a Nasdaq or a Dow Jones Industrial, right? And we are overperforming all the other markets at this point. If we look at the cross-currency dollar movements, then broadly we have only changed by 1%. Now, I do not say that it is not significant. It is significant. But if you look at the other currencies, Argentina, Turkey, obviously because of their inflation spirals, Russia because of the war, but all the other currencies like Malaysia, China, Taiwan, South Africa, Philippines, we have been able to be resilient against the dollar at this point. And like I said, I do expect us to strengthen against the dollar, which will also help us in a better inflationary trajectory. If you look at the growth concerns, the personal loans have been an important point for the Reserve Bank, that they have raised it here, that the credit card debt has been increasing significantly in the previous few quarters, which they do see as a concern because personal loans are generally unsecured. We do not have a lot of collateral around it. So any kind of NPS growth in that will have to be watched very closely. And that's an important point for the Reserve Bank to raise, and they have raised it rightly. As usual, you will see the housing market loan rates are steady. The loan growth is steady with that, and that also shows in the inventory around the housing, where the markets are showing a similar kind of pattern. If we look at the global comparison, probably one last item that I wanted to cover is how have the monetary policies of different countries been doing. If you see, we've had a total of 3 meetings. We've had meetings with full consensus, all 3 of them, and we've had variation in the policy rate zero. This is recently because this is April to September, but broadly we've raised 250 basis points from past year, May 2022. If you see all the other economies except Brazil, Chile, who have reduced the interest rates recently, they've cut interest rates, but everyone else predominantly has increased interest rates, including the advanced economies, including the economies which are not struggling at this point, but they are on a growth path where inflations are high. They are prudent, and everybody on the globe predominantly is trying to increase the interest rates. So that's broadly what the global economies are trying to do. With that, a few concluding statements. I do think that inflation to be tamed is going to take significant amount of time. So be ready for a good amount of steady recovery towards a growth path. It's not going to be fast. It'll take a good 1.5 year from here for us to reach to the 4% inflation target. And only then the Reserve Bank will really start thinking of any rate cuts. And those rate cuts are also not going to be very fast. There'll be 25 basis points, 50 basis points at best every bi-weekly policy. So by the time we go to the growth path, where companies again start recruiting, borrowing more funds, debt, and ability to take loans increases, it is a good 2.5 year cycle from here, which we have to bear in mind. So good companies will continue to thrive, but there will still be certain amount of slowdown in the economy. There will be certain amount of recovery phases in the economy. There'll be shocks in between because a lot is going on at the moment. We are seeing the Israel-Palestine war, which is going to affect the prices of commodities that come from there, come through the passage that passes from there in terms of the canals that get affected. So all of that will have an impact. So we have to be very ready. And I do see the Reserve Bank, and utmost respect to the Reserve Bank for that, but I do see the Reserve Bank ready with most of the tools that they need to. I think their assessment of the economy is way more accurate at this point as to where we really are and what we need to do in terms of the inflation patterns, and what do we need to do in terms of taming inflation. One of the most important points that I saw in one of the speeches was that the Reserve Bank's governor is not saying that the inflation target should be 2 to 6%. They're saying the inflation target is 4%. That means they're being very, very stringent and strict about bringing the inflation to 4%. And that is a good sign. In inflation taming, conservatism, goes a long way in building a strong growth path for the country for the next good 4 to 5 years. So I do see that coming, but it will be a slow path towards growth. So we are in the recovery phase. 2.5 years, it will be the recovery phase, and then on we should see another good boom in the equity markets. With that, thank you so much for watching and providing your valuable time. I hope this was insightful, and I'll see you in the next one. Bye bye.